Secure Financial Advisors, a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full informed investment decision. This is Your Money, Your Wealth on Talk Radio 760 KFMB. Now, here's Joe Anderson and Big Al Clopine.
Hey, it's a little bit after the hour. Good morning, everyone. Show's called Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner. I'm with Big Al Clopine. He's a CPA. Thanks for tuning in for the next few hours, talking financial planning, retirement planning, taxes, investments. 10 golden rules of investing for a richer retirement. That's the headline.
Wow, that got me right there.
Yeah. Yeah, but people are freaked out right now, Al.
Of course they are.
The market is a little volatile.
Sure. Yeah.
But it was a good week this week.
Better week, for sure.
Better week. Let's see. If you looked at Friday, Monday, or no, the markets were closed Monday, weren't they?
Yeah, they were closed Monday.
President's Day?
Yeah, so we basically had
Friday, Tuesday, Wednesday, Thursday. Or Thursday was flat.
Yeah, Thursday was flat. We had 3 days of growth. Friday, Tuesday,
almost 800
Wednesday.
points, though. Over 800 points.
Right. And Tuesday,
That's 3 days.
Thursday was flat, and Friday was kind of mixed, a little bit down.
3 days, Al. Almost 1,000 points.
Yeah, we like that.
And then so, when people went into cash, they might have missed about 800 points in the old Dow Jones Industrial Average.
Right.
I was listening to this radio program, and he's a market timer.
Okay.
Right?
Yeah.
And, man, he's a good salesman.
Yeah. Right.
And it's like, man, if you're not in cash right now, you're going to lose all your money.
Making
and
a big
look at
mistake.
2008, look at this. And
Sure.
And it's like when you listen to it, it sounds, because you're selling on fear.
Of course, right.
That's a pretty powerful emotion when you're dealing with your
too.
money.
Yes.
I don't want to lose any money. So if this person has that crystal ball to let me know when I should get in and out of the overall market, I think I should listen to them.
Exactly.
No one has that information, folks. And then you might be saying, well, Joe, you're probably just saying that because you don't have the information. And guess what? You're right. I don't have that information.
I guarantee that's what everyone's thinking.
I guarantee you. I do not have that information, but no one else has that information because it's very difficult to time.
Well,
so that's what we don't talk about on this show. We talk about things that you can control. You can't control the stock markets. You can't control interest rates. You can't control the price of oil. We can't control China.
Right.
We can't control what the Pope is saying about Donald Trump.
He's not a Christian. Did you know that?
I just found that out.
Anyway, you know what? Well, I can sort of prove it to you guys as to why nobody has a crystal ball, because you look at any publication or go to CNBC website, and so if the market's going up for 2-3 days, they have all the bulls on. Here's the reason why the market's going to go up in the next couple years.
Yeah, but you very rarely hear the predictions in a sense, because when you watch those programs and things like that, they can tell you hindsight what happened in the markets, and the markets went up because of this, and the markets went down because of that.
I know, but here's my point.
But a million different things happen throughout the day when it comes to thousands of securities are trading hands.
That's true too. But I guess what I'm going to say is when the market goes down a few days, all the negative, bears come out, start talking about why this is going to continue, and then when the market goes up a couple days, all the bulls come out and say why it's going to continue, and it's just a bunch of hogwash.
Hogwash.
How do you like that word? That's from my generation, Joe.
It's just a bunch of hogwash. But here's the fact of the matter is that what we try to talk about on this program here, Your Money, Your Wealth, are things that you can control in being a little bit smart about how you're dealing with your money, because everyone has hopes of retiring, someday, and hopefully it's real soon. But when you take a look at it, I've been doing this close to 20 years. Al's been doing this over 30 years. And, when it comes to managing a career or raising your family, there's very little time left for you to focus on creating a retirement game plan. Plus, the amount of information that goes into planning for retirement, it's overwhelming. I mean, if you would Google retirement, you would spend your entire retirement on the internet, right? And so you save, you hope, and you dream. But at the end of the day, you still don't have a plan. Should you invest in the stock market today, or should you run for the hills? I don't know, right? Because that's what's going on. It's like maybe I should wait until things get a little bit better. Then that's when I'm going to invest. Or how and when is the best way to optimize your Social Security benefits? How will you withdraw your money from your IRA or 401k so it doesn't needlessly cost you thousands in taxes, penalties, or fees? And how do you make your money last in retirement? How do you know that money's going to be there for the next 20, 30, in some cases, 40 years? So Al and I and our crack research team, we pulled out the best strategies, the most significant strategies that you could implement to make the biggest impact on your money and your retirement. So that's what we're going to try to get through over the next couple of hours, is really try to help you to implement some certain things versus, looking at a crystal ball and wondering, what's going to happen to the markets tomorrow. Because if you think about it like this, is that most of you have a 30, 40-year time frame. And I know some of you are thinking, well, wait a minute, I'm currently retired, or maybe I'm retiring next year, or 5 years or 10 years. That's my time frame. No, your time frame's end of life, right? And most people are living a heck of a lot longer than they ever have before. So you want to make sure that you have enough capital in your overall portfolio to maintain that lifestyle. And I would say most of you that are listening right now need to take some risk in the portfolio. So what does that mean? You need to have money in the stock market. You need to have money in the real estate market, right? Commodities and everything else. And so with these blips that we experience from time to time is a blip. You're not going to remember what happened in February of 2016 or January of 2016, 10 years from now, or maybe even, 10 weeks from now, right? We don't know what's going to happen in the future, but if you believe in capitalism, in the overall fact that most companies want to grow, build their profits, and increase the bottom line, well, you want to invest in some of those companies. And so if you don't invest in some of those companies, and if you invest in cash, CDs, money markets, things like that, what's the 10-year treasury, Al? It's like 1.5, 1.6 something.
Definitely below 2. Yeah.
And so it's like, all right, well, what do you do with the money? Well, control the things that you can control. Make sure that you have a game plan in place to take a look at how much money that you need for your lifestyle. Make sure that you're doing everything you possibly can to reduce the overall taxes on the distribution that you're taking. Take appropriate amount of risk in the overall portfolio. Be completely diversified. Manage your fees. Rebalance, tax manage. Right? It doesn't have to be as complicated because right now stocks are a lot cheaper than they were, 6 months ago.
Right.
So now is the time to be buying and rebalancing. So if you look at it in a microscope, you're going to freak yourself out. But if you look at more of a longer-term horizon, I think you'll look at this and say, all right, well, here, this is normal. The probability of the stock market to go down is high.
Yeah, we know it's going to go down.
But if you look over the long term, right, the stock market has gone up 70% of the time. Right, 30% of years it goes down, 70% of the time it goes up. I like those odds.
Yeah, better odds. And Joe, I think that's the key. Investing should be long term, right? Should be very long term. And when you think about investing, I suppose maybe we'll back up 1 second. There's basically 2 styles. There's people that are more tactical, that get in and out. Now's the time to be in the market. Now's the time to get out. And then there's those that stay fully invested in through all periods of time. And so you would think, well, gosh, the tactical one, that sounds better because maybe someone's got the crystal ball as to when to get in and out. But here's what's interesting. If you look at the academic research for the last 50 or 60 years, what you'll find is those that stay invested do better than those that try to time the market.
Right, because you don't know when the market's going to go back up. So you get out of the market, what's the alternative? You go into cash, that's not going to pay you anything. So you want to make sure that you have a balanced, globally diversified portfolio and making sure that your retirement lasts. Okay, we're just getting started. Don't go anywhere. Show's called Your Money, Your Wealth.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the program. Show's called Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner with Big Al Clopine. He's a CPA. Thank you. Thank you very much.
You're assuming they're clapping?
Yes. Very excited. That couple minutes of commercial break was just killing them.
And they just could hardly wait for us to get back on, right?
Boy. Well, it's a beautiful day here in Southern California.
Yes.
And, we get listeners all over the place. I think
we
6
do.
Other listeners in different parts of the country.
Well, now we're big because we're on podcast.
Oh, yeah. That's what I'm saying.
So and if you want to listen to our podcast, you can go to iTunes or you can go to our website, purefinancial.com. But, we've got people now that write us and call us from New Jersey, Texas, all over.
Yeah, it's very exciting. It's very exciting.
Still waiting for our first international call.
Yes.
If you're listening, if you're in Europe, please let us know you're listening.
Alan, did you know that there is 10 golden rules for retirement planning?
I do. I got the same article right in front of me.
All right, let's go through this real quickly here. We got about 8 or 9 minutes, so we can spend about 60 seconds or
On
so.
each one. Okay.
On each one.
Fair enough.
So educate yourself is number one, so you can take part in the planning process. I think that is very, very important because at Pure Financial Advisors, little plug there, our company that Al and I work for, is that education is key. That we've been doing this radio show for 10 years. We teach a lot of retirement planning courses at local universities, community colleges. If you go to our website, we have a learning center. I think that has over 200 videos on it. What we try to do is make sure that we empower people to because no one cares about their money more than you. You know what I mean? And so if you don't understand things, you have to be educated and knowledgeable about, at least, you don't have to get in the weeds on things, but I think that's where people fall prey into, maybe bad investments or Ponzi schemes or, maybe unsuitable, not necessarily unsuitable, but maybe into products that might not necessarily be as great as other solutions or strategies.
Yeah, I think the more you know, the better the decisions you're going to make. And you're listening to this show. We are a fee-only financial planner. That's kind of where you want to start. You'd rather talk to a financial planner that is not trying to sell you a product. And there's lots of good books. I mean, what would you, if there's a single book out there, what would you recommend?
For what? Just overall comprehensive financial planning or investing or
just
taxes?
To get educated. Overall financial planning.
I really like Rick Edelman's books.
Yeah.
The Truth About Money is a pretty good book. I've read that about 4 or 5 times.
Okay.
It's big, but it's
Sure.
easy to read.
Yeah. Larry Swedroe has several good books as well. Almost any one of his are good.
Yeah, I mean, his is more geared towards, how to construct the overall portfolio.
Sure.
Larry's been on the show many times. We have actually a recommended reading list on our website at purefinancial.com.
Right.
But getting educated. Or you could go to one of, I teach a retirement planning course at just about any local university here in Southern California. We're in Los Angeles. We teach in Orange Coast College in Irvine. In Mission Viejo, we also teach. And then in San Diego.
Several San Diego locations.
In several San Diego locations. So if you want to go to a retirement planning course, I think the cost is $50. It's 2 nights. It's 6 hours. You get a textbook. And then from there, you can take that information. In most cases, you can potentially then create your own retirement and financial plan. So.
Yeah, that's a good idea, Joe. I think the second one here is make an honest assessment of where you are in terms of your finances. And so what does that mean?
I mean, here's the problem. Now, this is a good point because I think a lot of times people approach retirement or they look at retirement with rose-colored glasses.
Right.
It's, all right, well, here, I haven't saved anything. But I'm going to retire, and it doesn't. I don't know. It's just like they think if they keep hoping, it's going to happen.
Yeah, I've actually heard a psychologist recently talking about the baby boomer generation and how they're very hopeful generation, and they always presume everything's going to work out fine. But when it comes to retirement, you got to take a look and see where you're actually at. You got to look at your assets and liabilities, and what that means is what assets do you have to create a retirement income? How much do you have in your retirement accounts? How much do you have outside of your retirement accounts? Do you have real estate? Do you have rental property? How are you going to create that retirement income? Then you take a look at, well, what am I spending, and what kind of fixed income sources do I have? Social Security is obviously one of them. Do you have pension plans? Do you have rental property income? You kind of got to take a look at where you're at to assess how close you are to retiring.
Right, and then that kind of leads into the third one. Do the math so you act on information, not emotion. You have to do a little bit of math here, is to say, all right, well, here's the assets that I have. Here's the income that I want to produce from the assets. Is it going to make sense? I mean, if you want to spend $100,000 a year and you have $200,000, all right, well, it's not going to last very long. So you want to make sure that you look at the math and say, how do I go about constructing this? And do I have enough capital to maintain that lifestyle? Or are you willing to significantly reduce your lifestyle? And then we hear this. It's like, well, I'm going to continue to work forever. Right? But here's a statistic for you. Half of people are forced into early retirement. Half. So for those of you listening, hey, you know what? I'm going to work another 20 years until I'm 80. I don't think that's going to happen. You have a 50% shot that's not going to happen. God bless you if you can do it, if you still want to do it. But unfortunately, with health issues and everything else that goes on, a lot of times people cannot continue to work as long as they want. Cash is not king, Big Al.
Yeah, well, that is true. And it's funny because I'm the treasurer of our homeowners association, and we have a CD that's paying about 0.3%, which is nothing. And so now it's finally coming due, and I'm looking around and I'm finding as much as maybe 1%, right? which is, so for a homeowners association, you want to take risk. But when it comes to your own portfolio, a 1% rate of return, you're just going backwards. I mean, inflation on average over the last 30 years has been over 3%. So if you're earning 1 and inflation is 3%, you're losing purchasing power. And the thing that people don't realize is when they retire, let's say that you retire at 65, you're probably going to live another 20 years, in some cases 30 years or longer. So if you have a 1% rate of return for 20, 30, 40 years, it's just simply not going to cut it.
Right. And so that's why having a strategy in place to, first of all, take a look. How much money do you have? How much money are you spending? Right? What is your other income sources going to be? And then create a strategy to make sure that you're making the right rate of return over the long term. Of course, it's going to, if you're invested in stocks or bonds, are volatile, depending on what type of bonds, of course, you own and what types of stocks you own. Educate yourself to understand how much risk that you're taking in the portfolio. A couple of others here is make an extra mortgage payment. So, there's two, I guess, rules of thumb here. I don't know if you can have two rules of thumb. Two different thought processes.
You got two thumbs.
You do have two thumbs. When you look at debt in retirement, all right, so a mortgage payment, all right, no one wants to have debt in retirement. I get that emotionally. I don't want to have a mortgage payment when I'm retired, right? Because that's extra cash flow coming out that you could be using those dollars on different things. But if you look at where interest rates are right now and the tax deductibility of that interest rate, and that it is a fixed payment for 30 years, right? It might make sense financially to continue to hold a mortgage payment. So emotionally speaking, pay it off. Financially speaking, maybe dive in and take a different look to see what makes sense. Another one, Al, is that looking at retirement assets and not understanding the tax consequence.
Yeah, that's very true, Joe, because most of your assets, if you look at it, are probably in retirement accounts like an IRA, 401k, 403b. And so when you start taking money out of those accounts, you got to pay taxes because you got a tax deduction going in. In some cases, you might have a little bit of basis tax-free, but in the majority, 99% of that income is going to be fully taxable. And it's very important to consider taxes in retirement because it's really not what you earn, it's what you keep. And taxes are something that you actually do have some control over as long as you know how to manipulate and utilize the tax code to your advantage. And the thing is, Joe, I would say it's common that people don't realize that they have any control over their taxes. But it's not true. In retirement, you got more control than any other time in your life because now you're creating your own income stream, and depending upon where you take those dollars out of is going to affect your income taxes.
Got to take a break. We'll be right back. Show's called Your Money Wealth.
Now back to Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the program. Show's called Your Money or Wealth. My name's Joe Anderson. I'm a certified financial planner. I'm with Big Al Clopine. He is a CPA. Thanks for tuning in. Alan, I got some things here that I was shocked.
Really?
So surprised that these things were actually taxable income to me.
Oh, it looks like you got 8 things.
I was super surprised on 8 things. Employee awards.
Employee awards, right? They want the government wants you to pay taxes on those?
Yes,
you don't
did
just
you know
get
that?
the awards?
Right. Rewards for doing good work.
Like if you go on vacation or you get a paid vacation?
Yeah, like vacation trips. I worked for a large Fortune 50 company, and I was a VP, and I received an award. I got this globe.
Okay.
Right? And
Yeah.
this is probably 15 years ago.
Yeah.
Got this really cool
That's
globe.
pretty. Yeah, that's cool.
Right? And I was like, wow, this is really nice.
Yeah.
Yeah. Then I get like a tax bill for it. It was like $500.
Okay, you got put on your W-2 or 1099.
Yeah. And then, I got the award because they took us to to Cabo San Lucas.
Oh, okay. Oh, for the award.
So we all went to Cabo San Lucas, right?
Sure.
We hit some goals or
Sure.
something like that,
Yeah.
right? So we're all in Cabo for like a week.
Yeah.
Great time.
Yeah.
Beverages, food,
Yeah.
5-star hotel.
Okay.
Yep. I got taxed on it.
Oh boy. Well, that's I would say that's true. That's in the tax code. A lot of companies ignore that, but that is true.
All right. Here's another one for you.
Okay.
Money won in a lawsuit. Did you know that?
Okay. Well, yeah, it depends what it's won for.
Well, you want to elaborate?
Sure. Yeah. So if you win a lawsuit for like wrongful termination, lost wages, or something like that, then that's taxable because it would have been taxable. But if it's for medical damage reimbursement, then that's not taxable. So it depends what it's for.
So you sued someone and then you settled out of court. Unfortunately, you have to pay the IRS.
Yeah, and here's the problem. You win $1 million, you pay the attorney $400,000, let's just say. So you get $600,000, but you have to record $1 million of income. You get to deduct the attorney's fees as a miscellaneous itemized deduction, but that'll throw you into alternative minimum tax, in which you don't get to deduct it in alt min. So you're paying tax on $1 million. Right? So by the time you get your money after paying the attorney, it's not quite as good as you thought.
What is it, $10?
About. Yeah, that's a tough one. So, yeah, it depends. It depends what kind of lawsuit. But if it's for any sort of lost income or wages, it's fully taxable.
How about canceled debt?
Oh, yeah, canceled debt. That's definitely income because you would have paid off the debt with after-tax dollars. That's why when it's canceled, it's income.
So we saw a lot of that 2009.
Yeah, right.
10.
Yeah, and in fact, remember the IRS came out with a special provision because so many people were losing their homes. So they said, all right, so the first $2 million of canceled debt on your residence, we're going to forget that that's taxable. Right, and they actually kept extending it. They even extended it this year, but it expires at December 31st of 2016. But the state of California did not conform, so it's still taxable in California.
Huh. Alimony, that's taxable.
Yeah, it is. Child support is not, but alimony is.
So if I receive alimony, because that's taxable income to me,
yeah,
does that qualify then for me to, let's say, fund a retirement account?
Yeah, that's a good question. I think you can. I think you read that actually.
I think I can. Yeah, if you want to fund a Roth IRA.
Yeah, I think the answer is yes.
So,
but
because, I mean, you're paying tax on it,
right? But you're not paying self-employment tax on. So
there was a couple because also if you receive disability income through your employer,
right.
That also would be able to qualify for you to continue to fund a retirement account.
I think that's right. So don't hold me to it, but I think that's right.
How many times do you think this actually is reported? Renting out a room?
Seldom. Yeah, that just kind of slips away.
How about Airbnb?
Yeah.
You know, I would imagine if you're on there, they would probably kind of take a look at that.
Well, they certainly could, and the problem with Airbnb is if you occasionally rent your home out, then if you're living in the home more than 14 days, which if it's your home you would, then you got to do this allocation between rental, right, and residence, and it's kind of a hassle. But yeah, I bet you a lot of people skip that. Now, here's a rule though: if you rent your home 14 days or less, you don't have to count the income.
Yeah, I'm reading that right here. Less than 15 days, you do not need to pay the tax on the profits.
Yeah,
so just rent your place for 15 days and charge like $50,000.
Yeah, right. And the corresponding rule is this: if you have a vacation rental and you use it for 14 days or less, it can be considered a full rental.
Is that a calendar year or a 12-month period?
That's a calendar year.
So, like, let's say right at the end of December, January, you could
you could straddle
like a 2-week.
Sure, you could rent it for 4 weeks. Yeah,
full month, right?
Yeah, right. 2 weeks in December, 2 weeks in January. That'd be fine.
All right.
Yeah.
Okay.
Yeah.
So there you go. There's a little tidbit for you, a little tax tip from Big Al, tax chat. Class action settlements.
Yeah, that's kind of the same as lawsuits.
Yeah, I suppose. So bank, gym, or phone company or some other business did you wrong by charging fees that you later declared illegal by a court, and you received some money. Great, says the IRS. If you expect settlement proceeds, then you got to pay the tax. So those are just a couple of little things there that you probably didn't know that was taxable.
Yeah, it is interesting, Joe. And so when it comes to taxes, of course, now we're in February 20th, I guess. We're already kind of in tax season, and people are getting their records and getting ready to prepare tax returns. And April 15th, of course, is the due date, except for this year. This year, tax returns are due April 18th. And there's a whole myriad of reasons why that's true. It has to do with a holiday in Washington, D.C. that's on a Sunday, so then Monday is the holiday, so the taxes are actually due on Tuesday, the 18th.
Only Washington, D.C. has that holiday?
Yeah, but it affects all of us, I guess.
But what's the holiday?
I don't know. I forget. But it's some holiday specific just to Washington, D.C., and so all of us get an extra day, which in some cases accountants are rejoicing because they have more time, but in most cases they're saying, oh my goodness, I have to do 3 more days of tax season? This is terrible.
Yeah, because you guys do always put it out to the last second.
Yes, we always do. But you know why? It's because our clients bring us the information the last second.
Oh, is that how it works?
That's how it works.
Oh, I didn't know that.
Have you ever noticed when you take your stuff to your accountant on October 10th?
14th.
You get
Hey,
it on
can we get this
October
done?
15th?
At like 8 p.m.? Oh.
Yeah.
No, I thought that he was just lazy.
Yeah. Well, speaking of tax, this tax deductions, 10 outrageous client tax deductions. Did you know that I was in this?
No.
Look at that.
Oh, my God.
I'm going to read this. I've got a picture of me in this publication, everything. Here's
Why don't you read that at the break, after the break.
All right, yeah, because I guess we're out of time.
Yeah. You want to talk about something?
Yeah, nah, not really. But I will say this, since we're on the topic of taxes, I think most of our listeners would like to know how to reduce their taxes.
I think so. Right now, I mean, people are, just starting the tax season.
Yeah,
getting things together.
Yeah. So do you know, did you know, Joe, you know what's coming? I hate taxes.
So do I, Alan. I hate them too. All right, we got to take a break. Don't go anywhere. Show's called Your Money or Wealth.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back. Welcome back to the program. Show's called Your Money or Wealth. My name's Joe Anderson. I'm a certified financial planner. I am with Big Al Clopine. He's a CPA. Thanks for tuning in. So Big Al is at the break here is bragging to me that he made the Financial Planning magazine once again on 10 outrageous tax deductions. And I go, well, how, well, that's a pretty cool article. He goes, yeah, most of them are terrible, except for mine, of course.
I'll read a couple. I mean,
I want to hear about the 10 outrageous.
Huh?
Let's just go the most outrageous.
Most outrageous? Okay, that's the last one. That's actually a pretty good one.
All right.
I'll read that one. So this is from Leon Labreque. Give or take.
Oh my God.
How would you pronounce it?
I'm not even good.
At least I tried. All right. So he's an advisor with KPR, Financial Advisors. Okay, so he goes, we had an adult entertainer. So
Oh.
get your interest
No,
right,
I already know. She
right off the
could
bat.
probably write off some.
Her boob job.
Yes. We talked about that a couple of years
Yeah,
ago.
but this is different.
Oh.
But you're on the right track.
Oh, boy.
So we had an adult entertainer that had been doing her own tax returns and writing off her costumes. So she got audited, and she contacted my prior firm. So we had to show the agent her skimpy costumes. So they took that to the audit.
Did she try it on? Oh, my.
And he said, which was a hoot. So he says, we lost the audit since the agent determined, and we conceded that the exotic dance costumes did have other uses of personal nature. So
Yeah, by entertaining a bunch of freak CPAs. Hey, well, let's get her in, guys. Hey, maybe she'll try them on for us.
you know, our buddy Ed Slott got in here.
Oh, okay.
I'll read his. You know him, Ed Slott, CPA.
Yeah.
Probably one of the most foremost experts on IRAs in the country. So this one was from an anesthesiologist who his friend told him he could buy a large SUV and write it off as a business vehicle. Well, you can if it's used for business. But then Ed said, well, you can't really do that since this was a personal vehicle. So I asked him, what kind of business travel would that be for? You're a hospital-based anesthesiologist. You don't have to travel to any patients. You travel to and from work. It's commuting. So he went back to his friend, and his friend told him he could take a full write-off saying it was an ambulance. The SUV qualifies for an ambulance.
Wow.
I told him his friend is obviously a better accountant than me, and I got rid of him as a client. Beware of clients with friends who are tax experts.
Yeah, right.
All right, you want to hear mine?
Yes, I do. I've been
It's
waiting
gonna
for
be
the last
awful
3 minutes.
after the other two. Okay, but this is a true story.
Okay. Well, I hope it is.
It is.
The CPA should be honest.
We are honest. That's our code. So a travel agent wanted to deduct all of her Grateful Dead tickets and related travel expenses because her business specialized in providing travel arrangements to Grateful Dead fans. So, of course, she came to me and said, I asked her, well, show me your expenses. And she went to about 50 concerts.
Wow.
She wanted to write all that off because that's where she does her marketing.
Okay.
So that was mine.
Did you do it?
No.
No.
That
sounds legit.
Yeah, not really.
No?
Not really. It made the outrageous list.
Ah.
Yeah.
So what, did someone contact you and say, hey, do you have something outrageous that...
Yeah, NAPFA, we get those things.
Oh, yeah.
National
Association of Personal Financial Advisors?
Yes, thank you. Anyway, so they said, if you have an outrageous tax story. So I sent mine in, and you know what? I've never had this happen before. The author actually called me and said, we love your entry. Can you send a picture? So I did. There it is, right in the magazine.
Oh, wow. Oh, boy.
So...
Oh, that was
pretty, probably, you probably liked the first one, right?
No.
The adult entertainer?
No, not even a little bit. I thought it was kind of appalling by those CPAs bringing her in and putting on that Claudio.
Well, it didn't say that she wore them, that they just brought it in.
Whatever. Well, he said it was a hoot. Okay.
I'm sure she wore them.
Like, really? Why is that a hoot?
Because we're CPAs. That's the best word we got.
Oh.
What would you call it?
I wouldn't say it's a hoot. I would be like, no, I don't need to see this crap. Get out of my... What are you talking about? No, it doesn't qualify.
You wouldn't, you wouldn't support a taxpayer in need?
Hey, Stan, I got this adult entertainer as a client. This is all BS, but maybe we can get her in
He's
here.
got the pocket protector.
Yeah.
Yeah, CPA.
He does. Leon. All right. Hey, I want to get into something serious here.
Something more useful?
Yes, because right now people are looking to retire now, and they go to us. And they're like, all right, well, what do I need to do here? So I want to get into some potential threats to your retiring, all right? And this is what Al and I see just about every single day here, is that a lot of you are in the sandwich generation. What the sandwich generation means is that, all right, well, you have elderly parents that you're caring for, and then you still might have kids on the payroll. And so money is going every which way but your overall retirement. So I found this was at NerdWallet, a pretty good article here. And it talks about boomerang children. One of the biggest financial risks to retirement is your own grown children. That boomers who supported adult children are more likely to still be working, according to a March 2015 study by Hearts and Wallets. It's an investment in retirement research firm. Only 21% are fully retired compared to 52% of boomer households who are not supporting their adult children.
Oh, well, there you go.
So, right, you keep them on the payroll long enough, you're jeopardizing your own retirement. I get it. You love your kids, but have them pay their own cell phone bill, Big Al.
Yeah, but it's a family plan.
Yeah, whatever. All right, number 2 here, caring for elderly parents. Studies provide some sobering statistics here about caring for your elderly parents. 11% of adult children younger than 65 provide money to parents. This is according to the National Institute of Aging. 25% of adult children younger than 65 help parents with things like chores and personal care, often at the expense of a paying job. In fact, people 50 and older who care for parents lose an average of $300,000 in pay, Social Security benefits, and pension benefits, according to MetLife.
Wow. Okay.
All right. If your parents need financial support, the National Council of Aging site is, what is it? It is, let's see. Go to the National Council of Aging. That website is a good place to find assistance programs that can take some of the burden off you. So, number 3 is a spouse dying without life insurance. All right. So this happened in my own personal family. My father passed away at 62 years of age and had about $8 in life insurance. And he was basically the breadwinner, owned his own company. And so, yeah, that kind of hurts a little bit. So make sure that you're properly covered, right? If you're the breadwinner of the family, make sure that if, God forbid, if something were to happen to you prematurely, is there something that's going to take care of the kids, the spouse, the surviving spouse, and everything else? Number 4 is a medical crisis. Medical bills are the leading cause of bankruptcy in the United States. Even if you can cover your medical bills without digging into your savings, an injury or chronic illness could prevent you or a spouse from working during those final years before retirement. Like I said earlier in the show, it's like 50% of people are forced into early retirement. Here's another one, retirement scams. Anxiety about not having enough money for retirement creates a fertile ground for scammers. Notable example, so-called 702 accounts, which are life insurance policies marketed as retirement accounts. Scammers often use free early retirement seminars as a way to pitch their strategies. This is out of FINRA, all right? So the Financial Industry Regulatory Authority. So be careful. If someone's pitching you life insurance as an investment, you might want to double check the fees, the cost of insurance, the liquidity of the overall product. Yeah, because it sounds great. You put money in it, gross tax deferred. You can pull money out tax free. And guess what? Oh, you also have this life insurance. Some people call it like a super Roth. Be careful with that. Sometimes, very few times it works, depending on, of course, what your health is, what the cost of insurance is, how much that you're funding it. All right, I got to take a break. Show's called Your Money, Your Wealth.